Hey everybody, it's Chris with Life 180, and today's video is going to be really fun. I've got some new information in regards to Index Universal Life. I've had a lot of people asking me about the nationwide New Heights Index Universal Life policy. With this information, basically here's what I know. I've told everybody in the comments I didn't know a lot about the nationwide New Heights. I'm still waiting on some illustrations from some people. For me, what I've done in the meantime. Last night, after a bunch of calls or a bunch of comments from people, it really built my curiosity. I went online, I looked, and so after that, and not really finding what I wanted to find, because the reality is a lot of the information on these products, it's actually kind of sad. It's not publicly available about how they actually work internally on a marketing perspective. A lot of the material is agent eyes only, right? As far as the education on the products, which it's not geared for consumers. And so what I did was I reached out to an individual who was one of the heads of advanced sales for a Fortune 500 IUL company. And I asked him, who now he's left there and he owns his own independent BGA, where he is representing over 40, I think 50 carriers. He deals with annuities, he deals with Index Universal Life, and this is his space. And so I asked him his opinion, and he actually gave me back a longer email than I anticipated, and it was a fascinating email. And so I actually copy and pasted that email into a Google Doc just to show, and this is actually going to make everybody who's interested in Index Universal Life, I think it's going to give you a little backing, right? Because he's a BGA for for Index Universal Life and annuities, so he's a big believer in Index Universal Life. But he also has a lot of background in whole life as well, and so he's like one of those people. He's one of the few people that I trust when it comes to his opinion on what's what, right? And so what I want to do now is I'm going to share my screen, and I actually want to go through this. I copy pasted it here into this, and you can see it's a little long. I've read it once. I just want to share, so I'm going to try to get through this as cleanly as possible. So when I asked him about the nationwide New Heights, this is what he said. So this product was just launched. I've not researched the product yet, but I'm happy to check it out if you have a specific. So I also asked him about his opinion on the industry right now as far as where things are going. So he said, we've seen three major shifts in pricing, regulation, mortality in respects to Index Universal Life over the past 2 years, and we're now facing a fourth major legislative change, that being the new rules in respect to max funding. This presents a real challenge to my space. The second you get your head around a carrier's lineup, they start over. Now, I'm going to keep going here. I don't want to divert. I'll probably give my opinion here at some point in time here. The bottom line is, for IUL, we don't know who is going to emerge, sink, or swim. Nationwide is a good company in general. They don't have the longest history with IUL, but they are run responsibly. They used to sell whole life insurance, but no longer. They may have demutualized as I think this through. And so I went through and confirmed that. Nationwide actually did demutualize in 1998. So they've been demutualized for a while at this point in time. So that said, here's the thing for Nationwide and he actually touches on it later, is that you're never going to outperform. Here, I'm going to pop it over here. You're never going to outperform an IUL based on the way it works. Can never overall long-term outperform the general account of the life insurance company. That's the reality of the situation. And so what they're saying is, on the whole life side or the IUL side, because of the nature of how they get the returns, you're never going to outperform the general account of the whole life insurance company. And so all these people illustrating way higher, it's just a different way to do things. It's a different way to try to create flexibility and so on and so forth. But the problem is, for me, the problem that I have is that people are selling these IULs as an investment, and it's not all bad, by the way. He's going to touch on it below, and so I'm not trying to just bang on IULs. But my challenge is people try to sell them as this investment that's going to have these massive, awesome returns. But the reality is, because of the environment, I don't think that's the case. Although he does have an alternative solution that I think is beneficial, that I think every Index Universal Life sales agent and person who's considering should wrap their mind around this and have the right expectations, and I think we're going to get into it. So an IUL, here we go. An IUL needs consistent old and new money via sales. As carriers continue to tweak and relaunch new generations of product or new lineups entirely, what happens to the old lineup, right? So he's saying, like, because of the nature of when they design these products and they reduce cap rates, and then they realize that they're not going to perform the way that they want them to perform, and they're not going to be attractive or what have you in the market, they have to create new products to do things. And so what happens to the old products? They have to just keep reducing performance in those products. That's just what happens. And man, I would love to get him on to do a live. I don't know if he would be able or willing to do that because of compliance. But this is a distinct advantage of whole life, in my opinion, right? Because carriers tend to stick with their whole life lineups longer. He uses National Life as the perfect example. If I bought National Life, Index Universal Life in 1997 through 2010, give or take, my S&P 500 cap is maybe 3.5%. If I purchased it in 2011, 2014, maybe it's 5 to 6% cap. Now he's saying cap, but that's not really cap. He's talking actual real performance at the end of the day after all things are considered. The trend continuing to new sales today may at maybe 8.5%. So actually, no, he is talking cap there, because that is the trend where they're going to about 8.5%. So what's going on there? He's saying there's nothing inherently wrong with Index Universal Life beyond obvious abuses due to bad sales practices and carriers treating old money different than new, which is a big deal. Once again, that's a lot of what I talk about in all my videos. If you haven't watched them, I'm not going to get into that on this video, but I've talked about this on other videos. It's basically a UL chassis, has some of the same pros and cons of any UL with a different method to possibly credit more interest. If you can find a carrier that treats old money similar to new, that could be a winning hand. The problem is with Nationwide, with this product that they have with the New Heights, I'm not going to say it's good or bad, but the dangerous part is they're not very old in the IUL space, so there's a lot of variables that are unknown. They can look really good on paper, but the fact that they're new in this space and they don't have any history shows you don't know what they're going to do if and when they don't perform the way that they're projecting at these higher cap rates, right? Because that's what we see happen all the time with these things. That may look like 7% on an old and 8% on new money, for instance. It won't be a chart topper for sure. So he's basically saying, like, it's not going to be, when you look at cap rates, it's not going to be these cap rates that are huge. The carriers that focus on new biz will show caps at 11% while others linger at 8%. So he's saying the companies that actually have the lower cap rates are the companies that are more responsible, that are going to be more accurate, right? Like they're going to be more conservative and more likely to actually have the policy perform at the rate that they're illustrating and that they're saying they're going to get you, right? And so that's a big deal. So lastly, if all carriers were honest, all S&P 500 caps, all S&P 500 high caps would be at about 5% today due to market conditions. How much upside exists? How much upside exists with a floor of 0 and a cap at 5? In summary, about the same that one would earn if they simply parked their monies in a fixed account via a UL at 3%. You'll never disintermediate, this is a big part that I was mentioning earlier. You will never disintermediate the general account of the insurer you purchase. This is true of whole life insurance as well, right? The key to IUL is designing it as a whole life to compete against whole life returns. So the key to IUL is designing it as a whole life insurance policy and to compete against whole life returns, not the BS that continues to drive sales. And so that is my big issue, as you know, that I've said, is that's the problem, is people try to sell Index Universal Life improperly. If you were to design Index Universal Life, and I've said this on multiple videos, at a 5% assumption, and you build it inside of the policy and as a 5% assumption, and you structure it the right way with minimum death benefit, maximum cash value, the right assumptions, and then you get some of the flexibility that IUL gives you, well then, if you're comfortable with that, I'm all about it. I could get behind that, right? but nobody's doing that. Everybody's illustrating 6, 6.4, 6.5, 7%, depending on the company. And that's where it gets really dangerous because it doesn't seem like a lot. You're talking 5 to 6.5%, but that's 1.5, 150 basis points on, added to it. That's a 30% increase in production, in performance. And what that does over the long term inside of a policy is it's unbelievable how much it skews the internal performance of the account. So you really need to take that into consideration. The IUL can benefit from less. Okay, so this is where you guys are going to like it. This is what I would say to everybody who's an index universal life person is that if you focus on illustrating an IUL like a whole life policy and your clients are still happy with it, these are some of the benefits that you think about. And you know this to be true. I know this to be true. But my problem is I'll get there in a sec. Let's go here. So the IUL can benefit from less restrictive borrowing, flexible premium components, better living benefit rider definitions, and other features. So I think that's all benefits to index universal life when you sell it properly, as long as you have all the other assumptions right. Now, he goes on to say, I wouldn't sell whole life using current dividend rates either. Neither would I. I always tell people you need to lean on the guarantees. What's the upside? What's the downside? Can I live with the downside? And that's what you go with. Maximum blending strategies. You wouldn't focus on using current dividend rates, maximum blending strategies with hypothetical dividend to pay premiums. So basically saying vanishing premiums using dividends to pay the premiums, because that causes all sorts of problems. Loads of term elements, unsupported PUAs, depending on how it's all set up, because you can abuse whole life as well. And that's 100% accurate. And that's why you need to make sure that you're really conservative with the way that you design each one. I'm just a bigger believer in whole life because of the guarantees that come with it, and so on and so forth. If you know a whole life policy you can get right now before 7702 kicks into effect, and you can get a 4% guarantee, well then why wouldn't you do that? There are some carriers notorious for allowing MECs to be illustrated as non-MEC. Okay, that's fair. And allowing borrowing that exceeds 90%, the 90% rule inside of whole life. That can cause problems. That's absolutely true. So once again, how you navigate, whether it's an index universal life or it's a whole life policy, how you manage your policy loans is very important, right? So that rule of thumb operates for both index universal life and whole life. And so there are problems with certain carriers where they allow that to be a problem. This topic is just so complicated, it goes right over most people's head. That is the fact. I believe the flaw is using an illustration as a crutch to sell. And so, once again, this is my biggest thing about index universal life versus whole life. Illustrations are great because, I think they're kind of like that necessary evil where you need to be able to see them to understand, and you need to have some kind of picture of what your personal finances are going to look like, what your investment, what your savings vehicle is going to do for you. Yet, when you start using illustrations to try to show the best possible result and sell on that best possible result, it's a pretty dangerous game to play. And it's not necessarily dangerous from an IUL perspective, like the policy is going to blow up. I'm not saying all these policies are going to lapse or eat themselves alive or anything of that nature. But what I'm a big believer is we have to have the right expectation management when it comes to our financial strategy, right? If you go into an assumption and you run an IUL based on 6.4% and the real performance of that long term ends up being 5%, because that's where general accounts are performing right now, it just is what it is. And so if that's the case, and you're never going to separate the general account performance of a company and what's actually being paid long term. You may have a year where it works, but long term, they're going to have to fix the cap rates. They're going to have to fix the fees. They're going to have to make it all work inside of the general account to make it happen, right? And so using illustrations to sell based on higher rates, higher expectations that are above and beyond general account expectations, to me is dishonest and irresponsible, and that's why it shouldn't even be legal, in my opinion, honestly. And they've put in some regulations recently in the last couple of years where, illustrative rates have had to come down inside of IULs, which is good, but I still think it needs to come a little further from that perspective. So the distinction between guaranteed and non-guaranteed is so different amongst different product lines, so misleading and ripe for abuse or misinterpretation. And so that is absolutely 100% true. And so in any event, I could go on for hours about this topic. I use IUL properly to outperform, outflex, and provide higher income potential versus whole life. And so that's fine, and I get that you can do that. My fundamental belief is I don't think I ever want to use an insurance product as an income vehicle. I know he runs a business that he does that. I know everybody who sells IUL believes in that, and that's fine. I'm not gonna, if you want to do that, if you're looking for that, I personally would never buy it for income distribution. I would buy a life insurance policy to have liquidity, use, and control of my money, to have access to capital, so I can take loans, borrow against my cash value in my policy, and then use that money to buy cash flowing assets, increase my wealth through real estate, other businesses, so on and so forth, use the cash flow to pay back the loans, increase the collateral capacity inside of the policy, while I have these other cash flowing assets, increasing my cash flow outside of the policy, increasing my quality of life, and all that stuff, buying hard assets that are going to be inflation protection, give tax benefits, all these different things. And the insurance policy is just the vehicle to help accumulate and accomplish this. Now, once again, it's all about expectation management. If you design an IUL at 5% and it looks great and you're comfortable with it to help you accomplish this, that's fantastic. The reason I don't use IUL to do it is because the problem is the way I do things, I need more liquidity quicker. And the surrender charges inside of an IUL for the first 5 years are higher than they are in a whole life policy. It's always a give and a take, right? And so there's more long-term potential in an IUL, but the surrender charges are higher, so there's less liquidity on the short term as far as the ability to design that in. So for my purposes and for the people that I work with, having the short-term liquidity is absolutely important for me to be able to get inside of these outside investments, right? To be able to get my money working for me and get that velocity of money going outside of the policy. So I hope that makes sense. If I have a more cautious consumer, I simply use whole life, but then I try to turbocharge a whole life to act more like an IUL, which is what I do pretty much every time anyway. In all actuality, I design my IULs down to be like a whole life, and I design my whole lives up to be more like an IUL. That meeting in the middle leads to a realistic projections and expectations. The idea being maybe I can outperform the whole life returns, 4% internal rate of returns long-term by percent. Basically bringing it to 5% internal rate of return, a 1% increase being an efficiency of 25% increase, right? The reality is something less, maybe 10 to 15% increase being more efficient. There are still contracts producing returns in excess of 5. I think what he meant to say, if there are still contracts producing returns in excess of 5% on paper, they are BS. This is whole life and index universal life across the board is what he's saying. If you really want to know how an IUL can perform long-term, the answer lies in the carrier's portfolio rate on all monies, right there, right here. That is it. You have to look at the rate of return on all monies, because that's ultimately, they can never pay out more than their general account on all monies invested is doing. So you have to look at all that, because it may look good on paper. They can have this product that looks really good, but if you don't, if their general account is not performing that long term, then they're eventually going to have to feed the general account, because that's what's going to pay their guarantees for other products. And this is what I try to convey to people in all my other videos. So it doesn't lie in the S&P 500 or whatever index they use as a mirage to produce results. That right there, right? Because remember, your money is never really invested inside of the S&P 500. It's using call options, right? Inside of the general account, and the results of that are what are being given to you, right? In the policy. And so if they're doing that for their portfolio, for the general account, if their general account isn't producing higher returns overall, then you're never going to get that overall. And they have the ability, this is the thing with charges and cap rates and everything inside of IULs. That's where, if it is actually outperforming the rest of the general account, that's where they're going to reduce the cap rates to even out the game, to make it so you're not outperforming the general account, so they're not exposed, right? Like that's just it. If a carrier is paying 3% on an old-fashioned UL, maybe the IUL can do better. How much better? Therein lies the mystery. I could go on all day. I need to go back to the annuities topic for next week because I'm doing some stuff with him on annuities next week, and that's going to be really fun stuff. So anyway, I hope this helps. I mean, like, this just kind of going through there, there's a lot to unpack there. I just wanted to share that content to really understand. I'm going to get more into this New Heights IUL because I think it's important to really understand. I think there's a lot of people that have questions about it. It's a really sexy product on paper, and I just want to make sure that people are not misled. They don't have misunderstandings about what the product's actually doing, because once again, it on paper, don't get me wrong, it looks really awesome. But the reality is you have to look, the company that's got it on paper, Nationwide, has not been doing IULs very long. I mean, they're relatively new on the grand scheme of things into the industry. And so we don't know how they're going to respond. You got to look at their overall general account performance. And if the product is indicating it's going to way outperform the general account, then that's something to be really sketched out about, right? So once again, it's all about expectation management. I would say if you get that product, have your agent run it at a 5% expectation. If you're happy with it, then get it. I would always, anything that I'm doing from here forward, and I've been doing this for a while, but look at IUL, run it at 5%, look at a whole life insurance, and look at the guarantees, and tell me which one performs better. Does the 5% assumption of an indexed universal life policy work well? Does the guarantee column in a whole life policy, which one performs better? And each person, there's a good chance that IUL may look better long-term. Whole life may have better liquidity short-term. So if you're a real estate investor, whole life is going to be better for you. That's why I say IULs are not great for banking, because you have too long of a period until you can actually tap into your money. So anyway, I'm going to get off my soapbox right now. I'm going to get done with this video. We'll get into some more stuff on another video. Make sure, if you haven't, go ahead and any questions, leave them in the comments. Any statements, leave them in the comments. I'm going to get deeper and deeper and deeper into this. Feel free to ask anything you want, and I will try to address it. Hopefully everybody can see that I'm doing my best to do this and keep a clear perspective, be objective about it, bring in people that I trust in the space, because there's a lot of people who are out there just selling this stuff and selling it unethically. I'm not saying everybody is, but there are a lot of people doing it. And so I'm trying to find the best of the best in the industry who can give you the great information. And hopefully that's what you saw that I did here today. So if you haven't already, please hit that like button. YouTube really, obviously, it helps the channel, helps us get a lot of traction, helps more people see this video. Share this video with other agents, because I think it's important that they see it. Anybody that you think is looking to buy an IUL policy, make sure they see this video. And if you haven't already, make sure you hit that subscribe button, hit the bell, that way you get notified every single time I launch a new video, especially if you're a life insurance agent, or if you're somebody who's looking to make a decision around your life insurance. I think there's not a better, more objective place, or at least that's what I'm trying to be on this YouTube network here, that is trying to serve this industry in the way that I'm doing it. So anyway, I hope this makes sense. I hope you have a blessed, inspirational day. I look forward to communicating with you and chatting to you on the next video. Take care, guys. See ya.